Okay, hi everyone. Let's take a look at problem 18-2A, which deals with cost volume profit analysis, break-even, contribution margin, margin of safety, and target income. We have Tyson Company. It bottles and distributes Local, a fruit drink. The beverage is sold for 50 cents per 16-ounce bottle to retailers, and the retailers charge customers 70 cents per bottle. Management estimates the following revenues and costs, and you can see all that information in the body. Okay, and then we're asked to do 4 items. Let's concentrate on the first one, which is Part A, where we're asked to compute the contribution margin and the fixed costs. Okay, well, without preparing a formal report, let's just type in what we know. Net sales. I'll work it over on this side. Let's just make this a comma with no decimal places. Net sales are 25. Then we have to subtract off, using a contribution margin approach, variable costs, right? And the variable costs that we know of are cost of goods sold, and the cost of goods sold is going to be a combination of a number of items. So we need to consider direct materials here. Direct materials are cost of goods sold. They're a component of it, 360,000. Direct labor is 650,000. So all I'm doing is I'm going to add all these in, okay? We need to add in variable manufacturing overhead of 370,000. And I think that's it. That takes us to 1,380,000. Okay, so we add those 3 items. We format this going down. All right. We have some variable selling expenses. And the variable selling expenses are $90,000. I'm going to format all of these that way. And I think there also, to the left of my mouse, is some variable administrative expenses. So the variable administrative expenses are $30,000. We'll put that in. That should give us our total variable expenses. And I'm going to actually call this total variable costs and expenses. I think it's a better title. We'll indent that a little bit. We'll sum from above. There we go. Total variable costs. We can underline this, and then it's easy to compute the contribution margin. Okay, so to tackle Part A, contribution margin is the sales less the total variable costs. And now we need to compute the fixed costs. Okay, so let's just keep on going right down the contribution, down an income statement prepared on the contribution margin approach. We'll subtract fixed costs, and what we know of the fixed cost is we have cost of goods sold, selling, and administrative again. Let's copy those down. Now I'll slide the screen a little bit. Okay, we'll move this back. I think I'll move this one back as well. We'll underline this for now. And the fixed costs, the cost of goods sold that were fixed cost, are the manufacturing overhead of 260,000. The selling fixed cost, the fixed cost portion of the selling expense were 200,000. And we need to format that. And the administrative expenses were 140,000. So we should be able to compute another total here. I'll change the words in a minute. That'll be the total fixed costs. And I'm going to again use fixed costs and expenses. Just my own choice of words is 600,000. And of course, then we could come up with operating income, or operating income before taxes. Probably more technical approach, and we could come up with the contribution margin less the fixed cost, and that would be our operating income. I'll right click and format that cell, make it a double accounting, and if we turn this to a currency, we've got a nice formatted statement. Okay, that takes care of part A. Okay, now I've slid up top so we can see the problem again. On part B it says compute the break-even point in units and dollars. Okay, as you all know, I'm going to just type this in. Break-even is equal to fixed costs divided by contribution margin, either in dollars or percentage, and using one gets you units, using the other gets you dollars. Okay, so if I make this 100%, and we just say take that divided by that, turn that to percentages, we get 100%. Now I'm going to lock in the D20 on the bottom as an absolute range and just copy where I need various numbers. Okay, so here's 60%, right? Total variable cost 1.5 divided by 2.5, 60%, so contribution margin is 40%. And that's really all we need, but let me slide down a little bit and just also jot down the fixed cost represents the 24%, so that when we're done, we've got a 16% return on sales. All right, but having done all that, we can then solve the break-even point by taking the fixed cost, which are 600,000, and then dividing it by the contribution margin percentage, which is 40%, and we come up with $1.5 million. Now, if we're dividing dollars by a percentage, the answer is in dollars, right? So that is our break-even in dollars. All right, now to determine break-even in units, we know that it says right above my mouse, the beverage is sold for 50 cents to retailers. Well, that's our customers. So if the break-even is $1.5 million, sold for 50 cents, then we know take the $1.5 million divided by the selling price, and we come up with 3 million units, and that's our break-even in units. Okay, not sure why this is formatted a little different. There we go. Okay, now part C says compute the contribution margin ratio and the margin of safety. Well, the contribution margin ratio we already have calculated. It's right there. It's that 40%. And essentially you could do it on total dollars or total units, right? 50 cents less 30 cents cost. That would be our cost per unit. Or $2.5 million less, excuse me, $1 million of contribution margin divided by 2.5 million of sales, and it gives us a 40% contribution margin ratio. Now, margin of safety is a little bit different. Margin of safety, you take the net sales less your break-even costs and divide it by net sales. So if I do margin of safety, I'll just do it right here. We'll take the 2.5. Actually, let me put this in parentheses. Take the 2.5 minus the break-even sales of 1.5, and then divide it by the 2.5 again to get the percentage. Turn it into a percentage, and it's 40%. So that takes care of margin of safety. All right, then on part D it says determine the sales dollars required to earn net income of 240,000. Okay, well here's our break-even dollars of $1.5 million, right? So the formula to do target income, I'm just going to copy it here. Let's do it this way. Target income is equal to fixed costs plus targeted income divided by the contribution margin, either in dollars or percentages. So if we want to come up with that, we would then take the sum of the fixed costs, which is the 600,000, plus a target income, in this case 240,000, and then divide it by the contribution margin percentage to get dollars, and that percentage is 40%. And we come up with 2,100,000. And that's the correct answer to determining sales dollars required to earn a target income or a net income of 240,000. Okay, thanks everyone.